Okay, good day, everyone, and thanks for being here with us today. My name is Anthony DeCandido. I'm delighted to serve as your moderator for panel session number 2, which is focused on sustainable at scale, middle market, large enterprise, customers, employees, and shareholders' perspectives. We have for you this afternoon a collection of impact experts who you'll hear from in a moment. But before we do so, let me provide you with some brief introductions so that we can jump right into the heart of the discussion. So I'm a partner at RSM, and I focus on our ESG impact advisory solutions, where we guide clients through impact strategy development, data collection, and reporting and communications. Like some others on the panel, I'm a SASB and PRI certified, and I'm thrilled to be enrolled in the NYU Sustainability course beginning in the fall of 2021. We have here with us also Jana Holt, who is the Global Director of Sustainable Investing Solutions in SEI's Investment Management Unit, where she's responsible for sustainable investing strategy and ESG integration across SEI's investment management business. Prior to joining SEI, Jana was a VP at Morgan Stanley's Global Sustainable Finance Group, where she led thought leadership, capacity building, and strategic initiatives for the Morgan Stanley Institute for Sustainable Investing. She holds an MBA and Master's in Environmental Management from Duke University and a BA from Princeton University. You heard from Captain Griffin earlier, but I'll share with you a little bit more about her background. She's the founder and CEO of Impactablex, where she enables social entrepreneurs and investors to define, model, quantify, and forecast social and environmental impact as a derivative of sales. They can effectively execute on their mission and leverage impact to drive business growth. She's a BA from the University of Pennsylvania and an adjunct professor at Temple University. And last but not least, we have also with us today Andrew Behar, who's the CEO of You Sow, the nation's leading nonprofit practitioner of shareholder advocacy and engagement. Since 1992, You Sow has used shareholder power to align investments with values and compel companies to reduce material risk on issues including climate change, toxins in the food system, ocean plastics, diversity, equity and inclusion, racial justice, and wage equity. Previously, Andrew was a documentary filmmaker and entrepreneur founding startups developing an innovative psychological monitoring medical device and grid-scale fuel cells. So I just said that very fast, and you won't believe it, but I did in fact skinny down everyone's file. So we have the right team here with you today. You've heard enough from me now, so let me jump into the heart of the discussion. We heard some talk of this on the last panel about the concepts around driving financial returns, but also doing societal good. So we understand one important fact, which is that all businesses need 3 things. They need customers, they need employees, and they need investors. And all 3 legs of that stool are sending signals that it's no longer good enough just to simply drive financial returns, but to simultaneously drive impact. We'll pick on Jana first. Discuss this point from your perspective. What do you see within your body of work that you cover?
Sure. Thanks so much for having me here this afternoon. So maybe to set up my thinking on this question, I'll share a little bit more about SEI for those of you who don't know us. We are a global provider of investment processing, management, and operation solutions. And we work with corporations, investment institutions, and other financial players. We have $1 trillion in assets under administration, which includes about $380 billion in assets under management in our investment management business, which is the side that I'm on. But I kind of want to take this question from SEI as a corporation rather than as an investor. So we were founded about 50 years ago. We just celebrated our 40th anniversary of our IPO. And we've grown to have today over 4,000 employees globally, and about 3,000 of those employees are based in Montgomery County, just outside of Philadelphia. And one of the things that SEI has really focused on as we've grown as an organization is maintaining a lot of the sort of employee-driven kind of startup innovative culture that we had at our beginning. And that has been really key to our success over time. And so, we often hear about, businesses thinking that you need to kind of think beyond the profit motive. And like you said, these kind of 3-pronged approach around, employees, investors, shareholders. We really believe that that is part of the profit motive, right? Is making sure that all of those pieces come together. We see growing sustainability interest from clients, particularly institutional investors and shareholders, but our employees are really a prime example of this. So we really focus on keeping our employee base highly engaged in our efforts to support local communities, to foster diversity, equity, and inclusion across our business, and to support our sustainability efforts as a company. So our affinity groups are a real point of pride for us on that front. We've got 6 groups that really help to empower and contribute to that culture and influence priorities and strategy across SEI. And so, that sort of lays the foundation. And then when I sort of switch my hat and think about SEI as an investor, we see that investors are increasingly looking to understand how those same factors affect the overall performance of an investment over the long run. So, SEI on the investment side is primarily a manager of managers, which means that we're hiring leading asset managers and specialists across all asset classes to make investment decisions in our portfolios. Those sub-advisors themselves are increasingly considering environmental, social, and governance issues as they make investment decisions. And then our own manager research team is conducting in-depth due diligence to really assess the capabilities, experience, and approach to ESG integration for those investors. So I think whether we think about it as a corporation or an investor, we're really focused on understanding the way that companies are attracting and retaining talent, meeting changing consumer demands, and increasingly meeting the enhanced expectation of shareholders around environmental, social, and governance issues.
Okay. And Jana, you mentioned a few things that struck a chord with me because organizationally we have a lot of similar level of focus between our employee base, our client base, and such. What do you say to the folks that view all these efforts as a distraction to benefiting financial returns of the business?
I think that it's not a distraction. When you think about it from the employee lens, this is what keeps people energized at work. It keeps them collaborating with each other, which we've all realized in this virtual environment is more important than ever. Helps us innovate and sort of stay ahead of where our clients are going and where the investment world is going. So I think that if not, at the end of the day, it contributes to the innovation and development of an organization when you're thinking about sort of a broad range of factors as an organization. And then as an investor, ESG or sustainability is really about adding more information to your process so that you can make a better decision. It's not about kind of restrictions or avoiding certain things anymore like it was maybe 20, 30 years ago. It's really about taking in that holistic view of an organization before you make an investment decision.
Okay. And I understand that Catherine's body of work focuses on some of the quantification of this information, and we as a firm, we're always struggling with the fact that what we can't measure, we can't track. And so every organization looks for some level of ROI on investments that they make, whether it's in the form of people, resources, or even financial resource. So Catherine, if you don't mind, can you share with us some of the exercise you complete on behalf of your clients to assist in the quantification of data to correlate to that level of impact for the organization?
Sure, I'd be happy to. And Jana, thanks for your insight. I'd love to build off of your comments as well. So our work focuses on, as you mentioned in the intro, defining, modeling, quantifying, and forecasting social impact, relating impact to revenue. We don't see these as mutually exclusive for companies that drive product-based impact. We see revenue growth and impact growth as aligned. The question is, what are the dynamics? And so what we ultimately are able to do is articulate social return on investment, generate an impact multiple of money per dollar of capital invested. So companies can or investors can get a sense of what the financial returns might look like. And then we model impact projections on top of that, pursuant to sales and revenue forecasts. What is the impact potential of this company? And then what kind of ROI can be generated per dollar of capital invested? So we're really articulating the dynamics and mechanics between the financial world and the impact world. and we're translating impact into insights and analytics that can integrate with the sophistication and sort of standard lenses accepted by the financial world. So I can talk more about how quite briefly. What we do is, as I mentioned on the last panel, we begin by defining a company's core metrics, what is most meaningful and measurable for a company. Then we align with the global standards so that our data and analytics are compatible with any other framework that an investor or other stakeholder might be using. Then what we do is we quantify impact on a unit level compared to a baseline. So if a company is selling a product that, for example, reduces crop loss post-harvest, we'll look at a baseline. What is the average crop loss post-harvest in the absence of an innovation? And then to what degree can a company reduce that crop loss? We always look for primary data, of course, for the earlier stage companies, or you'd be surprised, even for later stage companies, the impact data is often sparse. And so we help them make some initial assumptions and put measures in place to get smarter over time. Then once you have that unit-based impact, you can extrapolate of sales and revenue projections over time. Finally, what we do is we translate impact into economic value. We think of impact as value creation. And so we help companies understand the cost savings or new value created as a function of their impact, and really assign a dollar value to that impact over time. And then from there, we're able to translate it into summary analytics that allow entrepreneurs to effectively engage investors in particular. And so all of this information, a company gets a dynamic impact model that evolves as they grow. They also get data points that they can use to drive sales and marketing and engage investors, as I said. But I think it's important to note that impact data is often sales data. For the companies we're working with, the impact they're driving in the case of crop loss prevention, that's the reason why a customer purchases their product. And so by being able to articulate, they're able to really hone and refine their value proposition. And so that drives sales. That unlocks gatekeepers, the World Bank, various other sort of strategic partnerships that unlock access to new markets for entrepreneurs. And so that's the kind of insight that we're providing for companies. I also just wanted to quickly, if I could, respond to something Jana said. When we're talking about later stage public markets, an ESG lens is about looking at risk. So, what happened in Texas, where the infrastructure, the energy infrastructure came minutes away from complete devastation, that is a perfect case of how, not having an ESG lens exposes investors to risk. And so this isn't just about, saving the world from the goodness of your heart. This is really about sort of considering where your vulnerabilities are, and accounting for them, mitigating them, and reducing exposure.
Okay. That's fascinating work. I think in our client deck that we work with, we see many times scenarios where companies struggle to quantify, the level of impact that they're having. And that's why, my initial comments, said to you all that that's why a lot of these groups struggle to even undergo such a strategy, because they want to see the ROI up front. And, I want to hear in a second from Andrew about the work that he does, because what I've observed in our client work is the fact that there's still a lot of issues in the market around self-reporting, and the fact that companies have divergent systems to transmit information. They struggle to put together pen to paper on what's what within their organization, and there's a lot of news of late as to some of the governance controls and some of the watchdog efforts that have occurred, especially from the SEC around greenwashing and things of that nature. So, Andrew, if you don't mind, can you just share with us a little bit about the work that you do as a corporate watchdog and ensuring that you're advocating for all shareholders up and down supply chains?
Sure, and thank you. And I'm really interested in Catherine, following up with you after about Impactablex, because we do a lot of work in this area. So as You Sow is a 501c3, we're a nonprofit. We were founded in 1992, so we've been around nearly 30 years and focused completely on corporate accountability. And we do this through the lens of shareholders. So we represent shareholders and we engage corporations on a range of issues. Could be climate change, could be ocean plastics or toxins in the food system, racial justice, diversity, equity, inclusion, gender equality, a range of different issues. So we do a lot of data. We are a very data-centric organization. We start with doing scorecards. For instance, we have just put out a scorecard on racial justice and diversity, equity, inclusion on the S&P 500, and we're now expanding it to the Russell 1000. And we're looking at about 60 key performance indicators on these two issues. So we can evaluate which companies are leaders. We can define what our best practices within a sector, and then we can go talk to the competitors, to the laggards, and say, you scored a 6, your competitor scored a 60. Why? Like, what don't you see as important, and why are you letting your competitors just totally kick your ass on this particular issue? And also, this is how you can fix it. So whenever we approach a company, we do it with, this is material risk that we've identified, here's the data underlying it, and here is a solution. And I think because we take that approach as shareholder advocates, we get a lot of results. Last year, we engaged 131 companies, and of those, 55 the companies said, great idea, let's go do it. 76 we had to escalate to file a shareholder resolution. And of those resolutions, we get really big votes. We actually, just this year, we just got a 98% vote at GE. We got the highest resolution vote ever at DuPont on plastics, that when a management opposes a resolution. So we get the companies to actually make changes. We basically see ESG as risk, that's it, that this is what it means. Ultimately, we are, as shareholders, looking at the corporate decision-making process and going, we want to avoid risk. It's beta, it's basic business, that frankly people should know from business school or just from common sense, that when you treat your employees well, then you don't have the cost of having to recruit and to train. That's your biggest cost of goods. And so if you treat your employees well, create a culture that if an employee loves a company, is excited about coming to work, we've seen data that shows you get 200% literally double the productivity out of a person. And so these are just basic metrics that I would love to put more numbers to. We read a lot of McKinsey reports and things, but essentially ESG is risk. And that when you take care of your employees, when you take care of your community, if you don't, when you externalize your costs onto the commons, so if you're dumping toxins into a river, it's going to come back to bite you. You're going to end up it's going to get into a water system, and you're going to end up getting your own employees sick, as well as having litigation that's going to taint your brand. It's going to take you a fortune of PR to overcome, if you ever can. Your supply chain, having slavery in your supply chain. We talked to a company recently that scored 0. It wasn't our scorecard, but it's called Know the Chain. They scored a 0, and their competitors scored a 50. And we went and said, why'd you score a 0? Like, come on. And they said, oh, it's just slavery, and we're like, what? That's associated with your brand. And we ended up getting a good vote at the, we escalated it to a resolution, and they ended up changing their entire procurement system, rewriting all their contracts, which they really had to do, but we pointed it out to them and got them on the path toward that. So, and then ultimately, if you do all these things right, you're going to have a better company with longer term profits, with better returns that your shareholders are going to be happy with. You're not going to, shareholders also don't want to be associated with a brand that's doing a lot of these egregious things. Climate change is a big one. We're now working on what's called Say on Climate. Basically, every public company in the world needs to have a Paris compliant transition plan with absolute benchmarks that they report against every year. We're working in the United States with every public company, but there's a team in Australia, Asia, the EU, and in Canada that we're coordinated with. And we go talk to these companies and they all get it. They all see that climate change is going to destroy their supply chain and their markets. And they know that they've got to do their part. And frankly, countries are not going to make their Paris numbers if companies don't do their part. So this is a global movement. And there are some companies that have voluntarily agreed to it. Unilever, Moody's, S&P. And you look at these companies and you go, okay, this is like a global leaderboard of companies that are taking this seriously. Do you want to join that? And it's not difficult. You just need to simply, do the work. And a lot of them have already done most of the work. They already have putting out CDP numbers. They're already, have a plan. They have science-based targets. Just a matter of framing it in a different way. So we help the companies a lot. As shareholders, we really do a lot of great work with a lot of amazing companies that are reducing their plastic use, that are actually getting on the path toward racial justice, that are disclosing their diversity, equity, inclusion information. And so it's not a distraction. This is core business. This is just basics. And the companies who agree with this and actually put resources toward it are the leaders who are creating a really an emerging regenerative economy based on justice and sustainability. And the companies that don't want to go there are going to simply wind down because they want to stay in this world of destruction and extraction. And they will just simply not have the competitive ability to keep up with that. So anyway, so that's our view from a nonprofit looking at corporations and interacting with, a lot of the major corporations. And I think the work that both of you are doing in terms of your investing and also in terms of actually putting ROI numbers to the data is really critically important.
If I could just
That's great, Andrew. Yeah, so let us just pass it to Jana for a second. I think you've got some comments to add on the topic of advocacy, and then if we will, we'll just spend another 3 minutes on one final question. We'll do a round robin so we get a chance to hear from everybody. So Jana, please take us.
Thanks, and I just would love to underscore everything Andrew just said. We'd be hard pressed to have someone who's more expert on shareholder engagement on the call with us today. But as an asset manager, all of those things that Andrew shared from a nonprofit standpoint ring true. That shareholder engagement is a really important piece of the puzzle for asset managers and for the public market investing community. I think that there's a misconception that when we talk about sustainable investing, we're talking about divestment or avoiding certain types of companies. But what we really see is that by having a seat at the table with those companies as an investor, you have a really valuable opportunity to influence their direction. Help them manage risks by sharing what we see as best practices across the range of companies that we're invested in, and then encourage them and identify when they're taking advantage of opportunities, because many of these sustainability trends that Andrew spoke about, reducing single-use plastics, transition to a low-carbon economy, taking advantage of opportunities to make business more racially equitable, present tremendous opportunities for the private sector and for companies at large. And so as investors, if we can engage with companies, we have an opportunity to take part in the growth that comes from that. So shareholder engagement is an incredibly important piece of the puzzle for an investor. So thank you, Andrew, for your comments there.
Sure. Also, knowing what you own it's another thing. Most people, we're looking at $10 trillion of assets held by 100 million people in 401k plans. And we do an analysis of every mutual fund and we look at what's hidden. Like there's 88 mutual funds that in our 3,000, we're looking at 3,000 that have ESG in their names. And yet they get a D, or half of them get a D or an F on our system, on our rankings. So there's a lot of not good information out there. And right now what we've done is we just scraped all the 5,500s of all the companies in the S&P 500, and we're comparing their sustainability goals versus what's inside their 401k plans. And it's 180 degrees out of whack. Like actually Comcast is here in Philadelphia, so they do a lot of work on climate. They put forth, a whole image that they're working on it. Yet every person who works at Comcast is invested in big oil, in rainforest destruction, private prisons, and probably not many people are aware that that's how they're making their money. Amazon, similarly, they're buying 100,000 electric vehicles, yet every person's involved in burning down the Amazon. And so you just go like, and it's so easy to fix. So we're going to be rolling out report cards for every company later this year and inviting them to fix it and showing them how to do it, because this is not rocket science.
Yeah. Awesome. Well, I thank you all three for your insights on impact here. It's been a delight to chat with you all. We are up on time.